everyone. This is TK Kugler. I am the founder of Wasabi Ventures Stallions. And this is me live and in person. And this is the kickoff of Fund 4. Some of you have been in just looking at the faces and looking at the data. Some of you have been in all of the funds to this point, and this is the kickoff of 2023, which is Fund 4. Once again, I'm the founder of Wasabi Ventures Stallions and managing partner. And also on the call is our great George Adam, Director of Stallions and Breeding in the Wasabi world, and just an incredible, for those of you who don't know him, you'll get a little bit of it tonight, an incredible encyclopedia of anything that has to do with thoroughbred pedigrees and breeding. So I didn't build you up there too much, George, but you know, yeah.
I'll take it. I'll always take it.
Yeah, you it's well deserved. So what is Wasabi Ventures Stallions, and what is it that we're doing? It is a venture capital style alternative investment fund where all of the assets are thoroughbred breeding assets. For some of you, maybe you've been a part of private equity funds or a venture capital fund as a limited partner, and this is a fund that is just like that. Except that everything that in it is either a stallion asset or a broodmare asset. And we started this 4 years ago, and we'll talk a little bit about our history and what we're doing. Whoa, it one too many buttons. The other way to keep in mind is that this is an alternative asset fund. You're going to hear me talk a lot tonight about the fund and what we're doing and what we've done. It is important to understand that this is an investment vehicle. This is we're not doing this for entertainment. We're not doing this for education. We're doing this to make money. Let's just make sure that everybody is clear on that. Now, do we educate along the way? We definitely try to, and it's almost impossible for me to do something and not be entertaining. So, but at the end of the day, this is an investment vehicle, and it is an alternative asset vehicle. This is a quote from BlackRock, the investment firm and financial institution, really now, that talks about alternative assets and where they fit in your portfolio, and that's really a decision you'll have to make on your own. I will tell you, I've spent most of my life in the alternative asset business. A great chunk of my own personal wealth still sits in the alternative asset world. It's one of the great things about alternative assets is it almost doesn't matter what's happening in the broader market, because the alternative assets themselves dictate how well it's going to do. And you'll hear us talk a lot about that tonight. As we go through that, because it really comes down to the assets themselves. For example, just to give you ideas of what alternative assets are beyond the obvious that we're going to talk about tonight with breeding assets. An alternative asset could be things like wine or collectibles or art, anything that's not necessarily a public market. That's the way to think about alternative assets. Another alternative asset, like I said, I play heavily in is wine. I'm a regular trader of collectible wine, and so it's just something else that I do. So probably something most of you didn't know about me. So what are thoroughbred breeding assets, though? Once again, we're specifically talking about a venture capital style private equity fund that has, and all the assets are breeding assets. So the first one that we'll talk a little bit about is shares of stallions, and this is envision a stallion coming into that's in the marketplace and active, and it is literally a share. You can think of it as a share in a company. Most stallions, if they are set up as shares, Not all stallion assets are available as shares, but if they are set up as shares, it's usually 40 shares. Sometimes there are 80, sometimes there's 60. But I think the marketplace and history has set it up so that a stallion is split up into 40 shares. There's also lifetime breeding rights in stallions. The difference between a share of a stallion is you own the actual piece of that stallion, 1/40th, as we discussed. With a breeding right, it is just what it sounds like, sometimes called LBRs, by the way. Someone asked me today what an LBR is. It's a lifetime breeding right. And think of that as sort of what it sounds like. It gives you the license, you're buying a license that allows you to breed to that stallion in any given year. Sometimes a breeding right comes with 2 options in a year, sometimes it's 1. I think I've even seen a couple 3s, George, but not very common. But you can, but that's what that does. It gives you the right. And just like a breeding right, you can use it yourself with your own mares, or you can sell that. And there's rules around that, but that's what that is. There's also full ownership of a stallion. We'll talk about this in a minute, but that's how Wasabi Venture Stallions started, actually. One of our very first assets was we decided to buy a whole stallion and stand it ourselves. That was before we had the funds. It was a horse named Force the Pass, and we'll talk a little bit about Force the Pass as we come up in a couple more screens. But that's the other possibility that can happen in the fund. I'm not predicting that that'll happen with this fund. Probably highly unlikely, but that is a breeding asset that could exist. And then the last one, which we added for the first time last in Fund 3, is broodmare ownership. And that's actually owning broodmares and combining those in the asset class. So how do these assets get returns? And there's a document in the portal that goes into great detail about this. So I actually have an updated one that I'll upload right after this webinar. But if you log into the portal at wasabistallions.com, into your account, you can find some due diligence on how these assets earn a return. If for shares of stallions, there's an annual dividend that you can, from the shared pools plus the stallion bonuses that it earns, the sale of seasons, and the exit of the entire share. So think of, once again, every time you have a share of a stallion, you also get what amounts to a breeding right. So you have that ability, almost think of it like as a coupon. I tried to describe it. It's not exactly like that, but it's like a coupon on a bond in some ways, that you have this right every year that you can have a breeding, and you get that with a share of a stallion. And you can sell those. You can use those or you can sell those. And that obviously gets returns. There's the lifetime breeding right, which is just like a share of a stallion, where you have that sale of those seasons, that coupon can get sold, or you can sell the whole thing. We're going to talk about one we sold very recently. Sorry about that. Oh my. And then on broodmare ownership, there's the sale of individual foals, a partial sale of a broodmare where you may sell, pieces of her off. And then there's the exit of the entire broodmare. You sell the entire broodmare. Once again, Fund 3 is the first fund of the 4 that we've had, and Fund 4 already has some broodmares in it that we'll talk about. And we've got an exit already in Fund 4, just to tease that out for you. So I think, did I skip a screen? No, okay. Sorry about that. Yes, I did skip a screen. I thought I did. There was a little bit of lag there. Once again, I told you I'd be entertaining. So when does a fund earn those returns? So this is kind of a heat map, if you want to think about it. The darker the color, the more likely that asset gets returns during that time period. And because all of these could sort of have a timing, and we're going to talk about the J curve that goes with the fund here. But there's annual dividends from stallion shares, and you'll notice the best likelihood that you're going to get those dividends are sort of in those years 4, 5, 6, and 7, and to a less likelihood later on. And why would that be? Well, because most of the dividends from stallion shares are going to come once horses start running, right? The offspring have to start happening. There's an 11-month gestation period with a thoroughbred, meaning you breed 1 year. So if you're in year 1 of a fund, that's when all of these assets get used for the first time. Most of the income for all either broodmares or stallion assets are happening once babies are born, once foals are born. Okay, so that's why this timing sort of happens that way. Sales of stallion seasons, those usually kick in around year 2, and they're white hot through year 6 is the dream there. Of course, if something hits, then things are wonderful and it takes off. It stays orange forever. Maybe it becomes even a brighter orange, if you get into mischief the very first year, so to speak. Liquidity event of an asset, more than likely, although there's some chance of a stallion being sold earlier. We'll talk about force the pass, but generally speaking, if an asset's going to get sold, the more likelihood are in years 5 on, if you will. And then broodmare rentals and broodmare liquidity, you'll notice that those are in years, there's a better chance in those early years to happen, because those mares, the foals are being born, and it's almost in, within 9 months, you have a very good chance of getting some kind of liquidity out of that broodmare's foal. So because if you sell that foal as a weanling, you're going to get some kind of return fairly quickly. So that's why there's a little brighter color in broodmares. Now, if you'll notice, one of the great advantages, and we'll talk about why broodmares get added to funds, but one of the great advantages is it obviously smooths over when you start getting returns. You start getting returns from broodmares earlier in some ways than you start getting them from stallions. And so it gives that opportunity a little bit there that you may not get. The other chance that you have with broodmares is you have almost a pin hooking opportunity. We're going to talk about one of those in Fund 4, where you buy a broodmare and you get it in foal and you sell it within 6 to 9 months in some cases if you wanted to, and you time it correctly for certain assets. I've mentioned a lot the J curve. For those of you who are not familiar with the J curve, I have a whole video coming out later this week about the J curve. But a J curve is very, very important to understand in all private equity. And the key is to understand that you're investing in a fund that has got a long life to it. This is not a public market. All private equity funds are not public market. You can't just go trade them. You can't just sell them. You're committing to a long period of time, a 10-year period in this case. And in the early years, you'll notice that red line go down, and it's going to create a J as it scoops back up. You invest, we raise in year 0, and we raise the money from the investors, hopefully some of you on this call, and we take those dollars in and we invest those. We're buying those lifetime breeding rights. We're buying those shares of stallions. We're buying broodmares at auction. We are investing those dollars in. So the sort of value goes down. And then by year 1, but really by year 3, you're hoping you've hit sort of the bottom and it hooks way up. And then those assets appreciate, and hopefully we did a good job and we hit some really good assets, and they spike up in a big way in sort of years 4, 5, 6, 7, and on, right? That's the dream. That's what you want out of private equity. You want it to go down and then hook up sharply. So you want that to look like a J if we do this right. But the key takeaway is to understand in those early years, in the earliest year, in year 0, we're investing all of the money that comes in. all of the money that comes in gets invested in year that we get the money in from. And then we hope for that J curve to cook up in the following subsequent years. So let's talk about the history of Wasabi Venture Stallions. It all started in 2019. So believe it or not, we're really only 4 years into the excitement of what we've been doing at Wasabi Venture Stallions. And we bought up George doing incredible yeoman's work. We had looked at a bunch of stallions and we wanted to own a full stallion. And so we bought Force the Pass, a stallion. We bought that in September 2019. And we bred for a season. We covered 52, George,
57.
57 mares. Those, by the way, the very first foal is getting to a race on Saturday from Force the Pass at Delaware. So line by line, if anybody wants to check in, I think it's race 2. Maybe don't hold me to the race number, but it's race 1. So yeah, so race the very first foal is coming to this weekend at Delaware. But we bred, we did 57 foals, and we had an offer that we could not refuse. So for those of you who were investors in Force the Pass, you didn't think it was an offer we could refuse either. So we had an offer for $500,000. 1 year to the day we closed it from when we bought it. So 1 year from when we bought it, we sold him for 5x what we paid for him, and yielding a return of 3.69, because there are some expenses when you stand a stallion. And that was a pretty incredible return, candidly. So pretty big win, and everybody was very happy, and they got their checks in the mail. Go ahead, Mr. George.
I was just gonna say, and it's not over yet.
Yeah.
The horse on Saturday at Delaware, because it's Delaware rather than Maryland, won't earn us stallion bonuses. But when Force the Pass's foals run in Maryland for the next, however many years they run for, the Force the Pass's owners will get bonus money from that and we have no expenses related to him anymore beyond $200 or so a year to make him eligible. So that's not, that 3.69x is not the end.
It's not the end. So we can earn state bred bonuses. Stallions earn bonuses in states too, regional states. So like Maryland, Kentucky doesn't necessarily have the same program, but they don't necessarily need it. Then we launched our first fund in 2020, and then we've had subsequent annual funds in 2021 and 2022. A great number of you on this call have been in all 3 of those funds, and so thanks for all of the support. We paid out our first distribution of Fund 1 in June 2022. We returned 35% of the fund in the very first distribution for Fund 1. That fund now has been returned 61.67%. So that means we're coming up on 2/3 of the money has already been returned. If you remember that J curve, we're kind of hitting that bottom of that J curve right this second. We're hitting that inflection point. Hopefully, past results are never indication of future returns, but I have to do my legal disclaimer that I have to do. And but all things stay on path, and the way those assets look, it looks like we'll be close to returning 100% of the funds by year 3, which is pretty incredible for those that were investors in Fund 1. And then we look for the returns after that. So that's wonderful. We also paid out distributions on Fund 2 and Fund 3 this June. So all 3 funds have had distributions at this point. We'll talk some of those specifics coming up here in a second. So the net is the first 3 funds have performed admirably, wonderfully in many cases, and we're only hoping to continue that with Fund 4. So let's talk about Fund 1, and George will talk a little bit about the assets and give some updates. Once again, we returned 35% of the original investment to investors on the first distribution last year. Then we did another 26.67% just a couple of weeks ago, getting us to that total. In addition, we had our first asset liquidity event with selling one of the two Jimmy Creed LBRs. We had two Jimmy Creed LBRs in that fund. We bought two of them, and we sold one of them off. We had an offer, and we took that liquidity event on that. By the way, the IRR on that ended up being 26.67, I think is what, but we had which is an incredible IRR for those that invest in private equity. Really, anything over 13 on an asset means you did a really pretty impressive job. Whenever I let someone new into the call, it advances the screen. So that's why I keep having to jump around. Sorry about that. But so an incredible IRR on that particular asset. So we sold that. And so that was our first asset liquidity event in any of the funds. So George, why don't you take a couple minutes and just talk a little bit about the assets and give an update on where they are at this point.
Yeah, so the majority of those stallions that are listed there, all except for Jimmy Creed and Painter, were brand new stallions that retired to stud in the, what would that have been, the sort of winter of 2020 into 2021. So we're now waiting. All of them have their first yearlings this year. Fog of War and Honest Mischief are up in New York, and then Gift Box, Higher Power, Instagram, and Thousand Words are in Kentucky. Painter, we bought that share before Nick's Go won his first Breeders' Cup. So that was about a month before the first Breeders' Cup, and then he went and was Horse of the Year the next year. And within a couple of months after we bought that share, they had one trading for twice what we paid for it. And we paid basically his stud fee for that share. So we should do okay with that. Jimmy Creed bought 2 lifetime breeding rights. That was when Jimmy Creed had gotten off to a pretty good start with his runners, and it looked like he might sort of make the commercial jump. He hasn't done the commercial jump. He still gets plenty of runners and has a lot of respect from breeders. And so TK talks about that 26% IRR. We sold the seasons, or sold the right to breed to him 2 years before we sold the whole LBR itself. That's how we got that return on it. And we still have one of those. We have, and Wasabi Stables has had 3 foals by Jimmy Creed this year. So he's a stallion that still has some utility. And then all the other ones are new stallions. Instagram is one of the most popular first year stallions, or with first yearlings. They sold very well last year. We sold 2 of them quite well, as one is a weanling and one is a short yearling. Yeah, and for the first year that we did it, you can't just get a share in whatever stallion you want sort of off the street. We have, in even before the funds, we were buying shares in stallions, not that we didn't like the stallions, but we bought shares in stallions because we wanted to develop relationships with those farms, so that as we got further down the road, they would let us either call us or answer when I called them and said, can we buy a share in that stallion? And it is paid off. But you'll notice all the stallions on this list, the highest stud fee any of them have stood for so far is $10,000, which is not what we're anticipating with this fund. And you'll notice as we sort of move on, we have started working our way up the price point.
Yeah. So one of the key, George alluded to a couple key points about all private equity, but it's specifically about Wasabi Ventures Stallions, is what you're investing in is some level expertise and access. What we do, candidly, you can't do on your own. because it is kind of a closed private market. Someone asked me a couple days ago, wanted to ask the question for tonight was, so many of these stallion deals are done in back rooms and sort of special handshake almost situations. You know, how did you get yourself in those? Meaning, you know, he couldn't get himself into those. And I said, yeah, the difference is now we're in the back room. It's sort of taken us a long time, and a lot of hard work and respect from the industry. But we get access to almost any stallion asset we want at this point. If it is going to be available as a lifetime breeding right or a share, and usually things are not both, by the way. Someone asked me, most of the time people do one or the other. They don't do both. Sometimes they do, but in many cases they don't. It depends on the farm and the stallion in question. But we're in those discussions now. I had dinner last night with a farm manager, just laying out the groundwork to let them know when they bring in their next stallion, we're on the top of the list. And it only took about 8 drinks to make sure he remembered that, but I did. I took one for the team and did about 8 drinks. So he knows that we're on the top of the list now. But it takes, candidly, that's what you're investing in. Is that type of work. You're paying to make sure I drink is really the short answer. No, I'm joking, but it is having access to that. And part of that is, we'll talk on Fund 3 when we get there. Part of that is having great mares, brood mares. You got to remember, from the asset standpoint, the stallion asset side of things, is that whoever owns and is managing that stallion wants the very best mares to get to them. And if you don't have those, that's why we started moving those into the funds, so that we could have mares that would be very attractive. We'll talk about that when we get to Fund 3. Go ahead, George.
Mark asked a question in the chat a little while ago. When you purchase a stallion share, are you required to support the stallion with mares? And some of the syndication agreements explicitly say, yes, you have to. The Honest Mischief one, in fact, we had to commit 5 mares over his first 3 years at stud in order to maintain the share, or to fulfill your requirements, or we would have forfeited it if we had not met those requirements. That's more of a regional market type of requirement. But what the farms in Kentucky do, they want to sell shares to people that are going to provide mares, but also good mares. But because every shareholder mare is one less mare that they have to go out and hustle to get, and when it's so important now in these first and second crops to have as many mares as possible, they would rather have a shareholder that they know is going to breed as many mares as they can on that share the first year, the first 2 years, the first 3 years, than somebody who's just going to buy it and then the term is called pool those seasons and not use them themselves, and just expect the farm to sell enough seasons that the person gets a return from it. Again, not always explicitly laid out in the syndication agreement that you have to breed, but the expectation is there. And by doing that, you're putting yourself in a better position for somebody to answer the phone the next time you call and want to buy a share. When we can call and say, look, we bred 5 mares in the first 3 seasons to this stallion that we did with you guys last time, that's going to look better than if, we just paid for the share and then sat back and waited for them to send us our annual dividend.
Yeah. So all of that contributes to sort of that back room, if you will. It is about sort of making sure that you are respected. So Fund 2 update here for you. We've returned 38% of the original investment just about a week ago, maybe a week and a half ago. So for those investors on the phone, I actually heard from one today who is not a horse person. So once again, this is an investment vehicle. And he was on a cruise in Alaska, and he said, "I'm getting a what?" Because he didn't. We actually had to deal. Dee Dee's on the call. I see her shaking her head, but he was on a cruise in Alaska and didn't realize he was getting 38% of his investment back already. And this is a seasoned private equity investor who's an LP in a lot of funds, and so he was pretty shocked that he was already getting a return on his original investment. So, so really, it's gone very well. George, if you want to do an update on this fund as well.
Yep. So the same fund 2 was similar to fund 1, except for we had a little more money to spend. So we got a few more or similar assets. We did get a couple extra proven horses, which we have tried to kind of get some. It's mostly first years, just because that's sort of what tends to be most available. And a lot of times when you're looking for horses that are not first years, it's people trying to offload ones that have not made it. So we got lucky to get the Dialed In, the Golden Sense, and the Tapiture breeding rights in this fund were on the secondary market. Again, horses that had done well, we thought had some upside, and they have. Dialed In has a new Grade 1 winner. Golden Sense has his biggest crop of 2-year-olds hitting the track this year. And Tapiture has one of the top sprinters in training this year in Repo Rocks. And that's to go along with a bunch of really exciting young horses. We got into syndicates for Modernist and Raging Bull at 2 new farms that we hadn't been in before. The Raging Bull one, I actually, I heard Steve Bick's radio show. A guy from Gainesway was on there and mentioned that they had picked up the rights to Raging Bull when he retired. And I know the guy a little bit from when he was at the previous farm, and called and said, "Hey, I just heard you say this on the radio. Like, can we get a share?" And they hadn't sort of announced him yet or sent anything out yet. So that's part of the sort of back room. It's kind of, knowing who to call and when to call. So we did some more of that. These are, again, mostly young stallions. So they have their first foals this year. We have Wasabi has a really nice basin foal, a really nice Raging Bull foal, and a knock your socks off, rock your world foal that we switched and sent the mare back to him again because the foal was so nice. So these are some stallions that we think have, again, a lot of potential once their babies start racing. And we'll kind of be along for the ride and hope one of them, if not the next into Mischief, then we will aim a little lower and maybe it'll be Uncle Mo instead.
Uncle Mo, we'll accept them, Uncle Mo. That's fair. So, question from Neil asked, in Fund 1, why is year 2 a smaller percentage return than year 1? And some of that is that's part of the J curve, Neil. If when you have first year stallions, the books tend to be the best. Everybody, the thoroughbred breeding game is about selling a dream, right? And so people love buying and breeding to first year stallions. So that first year often is the prices on those first year stallions, which is what many of those assets are, is higher. And so that second year, it tends to drop off. There's usually fewer mares because there's a new first year stallion crop that comes in. So you sort of ride that bottom of that J curve down. That's why year 4 and 5 start to become very important. If hypothetically, if Force the Pass is, runs off the screen, if we hadn't sold him, that would start to make him a lot more interesting. Another regional stallion that we had is Blofeld that we have. That's a Maryland stallion. That's pre-funds that we have an asset in, but that we had breeding rights in. When his foals hit the track and started running, all of a sudden he became a lot more popular. And so you have that J curve. So you really got to ride those assets out in years to get to years 3, 4, 5 and see how they start to do. So years 3, how do they sell at auctions is another number. If they are selling really well, that can help as well. So do you have something to say there, George?
No, I mean, that's exactly it. And it has a lot to do with right now, the breeding business is driven more by the commercial sort of weanling and yearling sales market than it is by the racetrack. So Maximus Mischief is another sort of pre-fund breeding right that we have. He was very popular in his first year. He stood for $7,500 and he was booked full at $7,500. In year two, while those first babies are being born and people like the first babies, people are hesitant to breed in year two, because when you have a yearling from that second crop to sell, that's the year that Maximus Mischief will have his first 2-year-olds, which happens to be this year. So if he doesn't come out firing with those first 2-year-olds, you're not going to be able to give away a second crop yearling. So breeders are hesitant to breed in that second year. So you'll notice a lot of times, especially at a farm like Spendthrift, the stud fees for their second year stallions drop precipitously, because they're doing what they can to get as many mares in that second book, because it's not as easy of a sell as in the first year. And like TK said, by the time you get to the third year, sometimes Maximus Mischief was actually booked full again in the third year, because his first crop weanlings had sold so well and people really liked those foals when they got to the sale. So in the third year, he was booked full again at his advertised stud fee, which is unheard of sort of generally, but especially at Spendthrift. And then again, this year, he was almost booked full at close to the 7,500 with his first 2-year-olds about to run this year. And so again, he's got 3 winners already. So those second crop yearlings, which are the ones that'll be coming to the sales this summer, fall, hopefully should sell decent. They're still not going to, the second crop never sells as well as the first crop. Doesn't matter how good the stallion, there isn't sort of enough time in the year for the stallion to be doing well enough. By the time his second crop yearlings are hitting the sales, even a horse like Gunrunner, they might come close, but they're not gonna be as high in that second crop. So that's why the stud fee will typically drop, and there are fewer mares bred to second year sires. It's driven by the commercial market. So that's why the percentage return would have been lower in the second year, because the seasons sold for less to those what had been first year stallions, but then were the second year. It's fewer mares at lower stud fees. And that's where the return comes from that got distributed back out.
So fund 3, which was last year's fund, is the first fund where we added broodmares, and you'll notice a sort of separation here. And because we added the broodmares, we actually have we had a 16.5% distribution because of the way broodmares because we can sell pieces of the broodmares off, because we can sell seasons of the foals off, we actually get returns in faster. So that helps with that J curve, if you remember that J curve, because it flattens the bottom, right? Because now we're already returning money to the investors, so it happens faster. That's one of the reasons, besides the reason that if you don't have the broodmares, you don't get the assets. You don't get the stallion assets. So believe it or not, you got to have a male and a female to actually make a foal. So you got to have sort of both of them in to make that work. George, why don't you talk a little bit about the stallion assets, because I think there's some interesting new stuff in there compared to funds 1 and 2, and then obviously an update on the broodmares.
Yep. So you'll notice we fewer stallion assets and more shares. The lifetime breeding rights are cheaper to acquire, but they also don't have as much upside, and they are typically offered in sort of objectively less sure thing stallions, although every once in a while Spendthrift makes a mistake, and in Greatest Honor you actually couldn't get to him, and in those seasons were trading for above the stud fee by the end of the season when he was booked full. But Nashville on that list is a horse that, again, this is only because TK and I have been hounding people in the years leading up to this, that we were able to get a share in Nashville, which, well, we left on Fund 2, we actually got a share in a horse called Performer, which would have been slightly more expensive than Nashville. And then he actually passed away before breeding season, so we didn't get to. He was insured, luckily. But Nashville is the most expensive stallion asset that we will have had so far. At WinStar, one of the biggest farms down there, and it's only because TK and I kept hounding them that we got the chance to buy that share. Same with actually Aloha West. We've had a relationship with Millridge. They've sold foals for us at sales for a few years now, and that's how we got in on Aloha West to be shareholders there. And they only do one stallion every few years. So we're pretty excited to be involved with them. They're good people and they're doing things the right way. They stand Oscar Performance, who they did an excellent job with, even though he was sort of an outside the box kind of a prospect. And we think they're going to do a good job with Aloha West as well. And Highly Motivated is at Airdrie, and we had called Airdrie about 2 or 3 other stallions over the preceding couple of years that we would have liked to have gotten shares on, and just were told, sorry, there's nothing there for you. So finally, Highly Motivated, when we heard that, actually we ran into the Brett Brett Jones walking through the barns, TK and I sort of stopped
We
and
accosted him. We
accosted him
basically
in
tackled
person
him.
and said, we've talked on the phone before, but we're us, and love what you guys do and would love to get in on a stallion with you someday. He said, well, it's funny you say that. We just got this horse Highly Motivated. We haven't announced him yet, but we'll have a share for you if you want one. And it's just Vicky. Yes, everything is a 1/40th on all of them.
Yeah.
So it's we're getting access to better stallions now, and that's gonna hopefully make the long end of the J that much higher by the time they're longer, I guess, by the time it gets there on the upswing.
Yep. On the brood mares, once again, first year, all of those were acquired at auction in, I believe. No, I'm sorry, Mag Grace was not.
Were
That's right.
Yeah, runners. You guys had them as runners.
That's right. Sorry, I misspoke. So, but those are all in Fund 3. Fund 4. So Fund 4 already has assets in it. There are 5 broodmares that we acquired in February. And well, I guess Just Get It was January.
Yeah, that's right.
That's correct. So all of those are in the mix already. And so when you invest in Fund 4, you get ready-made assets. And if you'll notice in green, you get a ready-made exit. We acquired Just Get It at auction for $14,000, and we got a call about an hour later and said, I'd like to buy it. You guys did a good job and I'd like to buy it. And they came out and made a purchase the very next day, or I guess it closed 2 days afterwards, but they came and took a look at it the next day at the farm that we had moved it to, and they wrote us a check for $23,000. So the IRR on that is ridiculous, is what I would tell you. So, but we sold and got a $9,000 return. So that $9,000 return, if you're an investor, it's already part of what will be the distribution next year for you, because you're going to inherit that when we do a distribution. It should be covered that we do distributions in June and at the end of the year. If there's distributions to be done, it's twice a year that we shoot for. Historically, I realized that we skipped a slide that was kind of important, so I'm actually going to go. I'm not sure where the slide went now. Stay with me. There it is. I'm going to go back. So that's, I think in my letting someone in, I hit the button twice and I was like, I don't know where that slide went because I know the slide exists. Let's talk a little bit about what the fund is and how it's structured. I totally skipped that. And once again, I should have done that much earlier, but we got excited and jumped in. So the fund is structured. It's a Delaware Series LLC fund. You will get a K1. The team is very diligent on getting K1s out. We try to get K1s out early. I run a lot of funds, not just Wasabi Venture Stallions, but I run other funds. And Dee Dee is on the line. She is part of the team that helps get that out. She's also an investor in the funds. So she's here with two hats on. She's part of my team and she's also an investor. But we work very hard to get the K1s out early. If for any of you that are in other funds, sometimes you're waiting. I am still waiting on a bunch of K1s, not necessarily connected to stuff but I am sitting around. For those of you that don't know, I also produce movies. And so every movie is its own K1. So I'm waiting on a K1 from a movie that I produced, which by the way, is going to be at the Toronto Film Festival this year. So if anybody's going to the Toronto Film Festival, make sure you check out my movie, Mary Good Enough, at a theater near you coming soon, I hope. Anyway, I digress. It's an annual fund with distinct assets, meaning, once again, we do vintages. Think of it as almost wine. This is this year's vintage. All the investments we're going to do, or hopefully we're going to do them in this year. We're going to raise the money. We're going to invest in stallions and broodmares all this year. We're going to invest all that money. And next year, we're going to raise another fund. It's a 10-year fund with a 2 and 20. So what does that mean? So we're shooting for the fund to finish in 10 years. Now, when we get to the end of 10 years, just to be clear, we may not finish. But what that means is we're attempting to liquidate everything by the end of 10 years. Now, we may get to 10 years and decide that we want to keep the fund going, and we will, but there won't be any new fees to you. This is a lot of people asked about fees. Once you put your investment in, there are no new fees. There is zero chance that I come hunting you down and saying, I need more money from you. There will be no more capital calls. There's no calls for expenses above, beyond what you put in your investment, okay? So that is my personal guarantee to you. If ever the fund needs money, I'm gonna pay for it for myself. That's my personal commitment to you. So if you've been in other private equity funds, that's not necessarily how the world works. I will tell you that. But in this case, that is how we work. It's a 2 and 20. What that means is we take 2% a year for the 10 years. So cumulatively, it's 20%. We take that as an expense and a fee to run the fund. Believe it or not, Dee Dee doesn't work for free. So I actually have to pay her and I had to do taxes and legal and compliance and a whole bunch of other stuff. But all of those expenses come out of those fees. There are no other fees. Once again, very unusual because many funds will charge you those expenses on top of the fees that they take, but I do not. And then the 20 part is what's known as carried interest. Once you get if you're an investor in a fund with us, fund forward, once you have gotten all of your money back, the next dollar of return, the fund earns 20% of that dollar. So you'll get 80 cents and I'll get 20 cents, or the fund does, but it's mostly me. Well, George, actually, you get a big chunk of it, actually, if I remember correctly, the way I set it up. But it's that's what that means. But the carried interest, none of that, we don't get any of that until you get all your white meat back. You get every dollar back as an investor before any carried interest kicks in. Okay. So there's no extra cliff or anything weird there. It's all about getting all of your money back before any of that kicks in. It's only marketed and available to US-based accredited and qualified investors, okay? If you need to look up what the definition of an accredited or qualified investor is, you can find that online. You just Google it, it comes up pretty quickly. We have a certification process in the portal for you to do that. But you do have to be US based. That's the law. It's not my laws, it's everybody's laws. So that's what it is. One interesting note for you: the House of Representatives passed a law or passed a bill about a week ago that is going to change the accreditation laws, so that anybody in the United States could be an accredited investor. But that's not law yet. Hopefully it is by next year, but there are specific income and asset rules to being accredited. It's a $5,000 minimum investment for the first 30 days, meaning the first 30 days of the fund is open. It's a $5,000 minimum. It's $10,000 after that 30 days. That gives everybody who's an existing investor, anybody that's getting in early, gives you a chance to get in at that 5,000 minimum. I can tell you, I have spoken to a lot of people, and a lot of people are putting way past the minimum this year. But you know, everybody's got their own situation. It's a $250,000 maximum now. Actually, that's actually a misprint. We moved it to a $500,000 maximum investment, mostly so I can invest. I'm a significant investor in all the funds, just to be clear. So is George. Both George and I are investors in the fund, so we believe in what we cook. We're targeting between $1 million and a $2.5 million fund this year. So significantly larger fund. So you'll probably see significantly different increased types of assets in Fund 4 that you're already seeing. George, did you have something to say there?
Yeah, Thomas, maybe somebody had asked a question about tapiture earlier and whether we might pick up another tapiture share or breeding right. And I said we would address it later. The answer is probably not, only because we're targeting a higher price point stallions and brood mares for this fund. So as much as I still like tapiture, and we sent 2 mares to him this year and have no plans to divest of our interests in him just yet, because he is still very useful. He is not a horse that probably makes sense for the 2023 version of the fund, just because we're trying to get it sort of to a higher level of broodmare and stallion for this fund. So there will probably be fewer stallion assets again, but they will be at fewer stallions, higher stud fees, higher share prices.
The one thing that, and as we feel free to ask any questions, happy to try to answer those for you. It's important to understand that this is, although we've done extremely well, there is always an element of, you got to get some good luck here, because you are dealing with living, breathing creatures, and there's risk here. Like every investment in life, there is risk, and this is a risky investment, maybe even on the higher level in some ways, that because you are dealing with living, breathing creatures. The foals can slip, meaning a mare can, abort a foal, and you don't get paid. You don't get paid as a stallion owner, and you don't get paid as the broodmare owner if she slips. George mentioned Performer. We had a stallion in Fund 2 die maybe a week or two, not too many weeks after we bought a share in him, and luckily we had insurance. We have insurance on most shares, for the first year for sure, to cover things like that. And so luckily we had insurance on that, but that's what happens. So it just depends. So there is risk here. So I want you to understand that. And obviously we try to mitigate it in the best way we can. David Conway, am I correct in the mares in Fund 3 look to be higher quality than those in Fund 4? I don't know about that, David. We could talk a little bit about the auctions that those came out of. They were very different auctions, and that's probably why the prices are different. That has more to do with the market and opportunities and who the buyers are in November as compared to February. That's probably more of an indication there than I wouldn't use the word higher quality at all.
Yeah, it had a lot to do with when those auctions were held. But you'll see we already sold the one filly for almost twice what we paid for her. And we actually, TK got a call on Frame of Mind, less than a month after we bought her. Because when we bought her, Wet Paint, who ended up going off as the favorite in the Kentucky Oaks, she was a winner, but didn't have any black type yet. And a week or two after we bought Frame of Mind, Wet Paint won her first stakes, and then she won a grade 3 at Oaklawn. And Fazig, which is the auction in February where we bought Frame of Mind, called TK and said, hey, that was a really nice update. Do you want to put her in our next digital sale and double your money? And we were flattered, but declined, because she's going to be worth more than that, because that 2-year-old half brother of hers by Into Mischief is on the work tab, and they think pretty highly of him. His name is Collins, and he's with Brendan Walsh at Keeneland. But it had everything to do with when in the sales season we got these mares.
It's also should be noted that, like Yuletide, for example, you might say, oh, it's a $3,000 mare. That must not be very good. We actually think Yuletide is one that we're going to pinhook here. So that's going to be we're hoping for a fairly quick exit here in the fall.
Right. We bought her and bred her to Maximus Mischief, who we believed was going to be one of the leading first-year sires, and thought that we would be able to flip her for more than sort of that addition this fall.
So that's once again thinking about that J curve, and Holly, this goes to your question. You really try to put together, it's a portfolio, right? It's it's not all assets are at a certain price point, or that you sort of have to sort of think about value as you do it. And so Yuletide was opportunistic. We were at an auction, we saw something that was on our list. We saw value there.
Second horse in the ring too. So
it was literally, there was nobody in the auction ring. We had already done our research on it, and we stole it. In our mind, we stole it for $3,000. So that's the story. So you have to be careful in the game. There's plenty of statistics that will tell you that if you only look at price point, then you are only going to look at an empty bank account if you play the breeding and racing game. So it's very important to not always look at just the dollar figures. Now, of course, there is a correlation to some degree, but it's about value. If just get it, we bought it 14 and I sold it 2 days later for 23, that's still $9,000 in profit. It doesn't really matter how you look at it. It's that means you got value. Now, do I wish it was 140 and that I sold it for 230? Sure, I guess. But at the end of the day, from a proportion standpoint, when you buy value and you can extract value, the starting price point is less important. It's not a direct indication of how well you did or how valuable something is at that point. Hopefully that helped answer a couple questions that were floating around there.
And just to address Holly's question there about the fewer stallions, it increases the risk, I guess, in that you have fewer chances to hit the bullseye, but also with stallions at a higher price point. First of all syndicates the reason that the syndicate model is structured the way it is because over the history of stallions in the United States, they were all structured so that the guys who owned the stallions made their money back before the stallion failed. That's the idea is you might not hit a home run every time, but you're very rarely going to sort of strike out completely. You're at least going to hopefully wind up back where you started, and then you can try again with the next one. But also those stallions at the higher price point, the drop off in stud fee and mare support from year 1 to 2 is lesser with higher quality, or what perceived higher quality stallions. People like shareholders are much more likely to support a stallion at a higher price point in the second and third years than a $7,500 stallion. Just that's sort of the nature of it.
Yeah, just a question for Thomas. Do you look at sire lines that we don't already have a stallion from to help our overall breeding program? Not, I'll let you answer that, George, but
yeah, I mean, no, because each fund is its own entity. So
yeah.
we wouldn't not take a share in a stallion in fund 4 because we wouldn't not take a share in a son of Into Mischief because we already have shares and breeding rights in whatever it is, 3 or 4 or 5 sons of Into Mischief. He's still the best stallion in the country. First of all, there's nothing that says any of those stallions are going to hit. And even if they don't, it doesn't mean that the one in front of us that we're going to like any less. And as far as improving the sort of the overall breeding program, I mean, we're going to improve the overall breeding program by getting in on the best stallions we can and buying the best mares that we can. And like right now, just to use Into Mischief as an example, he's the best stallion in the country. His sons are the hottest things out there. So we'd not be improving the overall breeding program by foregoing the chance to get in on another one of his sons just because we were already in some of his other sons.
Vicky asked overall target for returns. I don't really think about, honestly, in any of my investment vehicles about an overall target. It's a dangerous way to think about these things, either as the managing partner or as an LP. It's because private equity is so unpredictable in many ways, it's hard to think about a targeted return on a portfolio of assets. So in the same way that probably no different than you may not think about a targeted return if you buy a single share of a public company. You don't think about the return, you buy a quality asset and you watch that asset appreciate, right? But it's hard to think about a target. But no, there isn't necessarily a target return. I think there is a very likelihood that if we're successful, that 4 and 5x returns are possible, I think is probably the better way to answer that question. So thanks everyone for coming out tonight. By the way, the fund is officially open. You can go to WasabiStallions.com tonight, right now, if you want, and invest. I can't wait to see what we get in Fund 4 and all of you to be a part of it. One last question: with more capital in Fund 4, is there a goal for more quality than quantity? Yes, for sure, Mr. Jerry. The window to close to invest is December 1st. The fund will close on December 1st, or once we get to $2.5 million. We will not go past 2.5 million this year. So if we do collect and get 2.5 million in investment, it'll close before then. But that's the timing on the window. So once again, go to WasabiStallions.com. Look forward to all of you, and I hope to see you on Slack as well.